Welcome to the Pop for Success podcast, your ultimate destination for business optimization and success strategies. I'm Ross Armstrong, and this is Stephen Blitz, and we're your hosts. Today, we are discussing what investors want to see when evaluating your business. We're going to discuss some of the key performance metrics and what you can do to start making your company more attractive now.
Ross, episode number 4.
Here we are.
We're doing it. So if you're a business owner looking to exit M&A, maybe you're younger or you're looking to acquire, we're going to discuss what is it that we should be looking at. How do we make the company more attractive? How do we make the business ready to go to get the highest valuation? So we're going to start today by starting in the key financial metrics. We're going to bring this down and simplify this down to 3 specific metrics. The first one being around the revenue and growth. Second one about profitability and margins. And third one is kind of bringing it all together with the cash flow. So under revenue and growth, the most simple thing to look at is the ARR and the MRR. This is the annual recurring revenue or the monthly recurring revenue. How much money are we making every month? And how predictable is it?
Stephen, what if we're not getting ready for a merger or acquisition, or we're not getting ready to sell or don't plan on selling our business? How can planning or looking ahead for these types of transactions help us in our day-to-day business?
Sure. So a lot of problems come out is that we're looking at the business and we're saying, hey, I'm not looking to sell for another 5 years. Well, the problem is that in 5 years, when you're looking to sell, they're looking back 3 to 5 years always. So if you're just thinking, all right, I'm going to fix this right before I sell, you're not going to get that valuation that you want. You're going to get the valuation that you kind of put yourself into. So taking the time and doing it this way, and I'm not going to say the right way because I don't believe there is a right way. I think it's a right way for specific business owners, but not necessarily for every business owner. Having those recurring revenues and getting that stability is important.
Can you explain to our viewers what the X factor or valuation metrics mean?
Yeah. So the X factor valuation, when we look at it, we call them, I call them turns. It might be multiples. You'll hear a lot of different ways. We'll look at an EBITDA, earnings before interest, taxes, depreciation, amortization. It's another way to calculate some level of a cash flow, but we're going to look at the EBITDA and, then do a multiple off that. Businesses can sell anywhere from a 2X if it's a very small business, owners extremely active, to you'll see businesses sell at 12, 15X and above when there's a big future story there. At the end of the day, the story matters, where it's going, not necessarily where you've been. While that is an important part to understand where the story is going and where the train's moving to, where it is actually on the tracks and where it's going on the tracks is more important. So when we're looking at the MRR and we're looking at these recurring revenues, we're saying, hey, I'm an industrial service company. I work inside of plants. Am I doing ad hoc services and getting paid on an ad hoc basis? Those are generally more profitable jobs. So a lot of business owners prefer those. Or am I getting into a contract where I am their go-to person at a discounted price? I'm going to get everything up into this volume, not having to worry about competing, but I'm having to give that discount. And what the benefit there is that I don't have to worry about competing. I don't have to worry about, am I going to get this job or not get this job? I may be the best one and I'm going to get the job either way. But from an investor perspective, they may not know that already. Or maybe you're the best one because of you. And so leveraging that to get an extended time under contract for an exit provides a story saying your revenue is going to be consistent. It is not going to change. And that is how you're going to get extra turns of the valuation. If you're making $1 million and you get an extra 3 turns because you have that, well, that's an extra $3 million. Maybe you're making $1.5 million because you're doing the ad hoc services. So you make an extra $500,000 a year. Well, is that $500,000 a year worth more than the $3 million or $4 million you can get in valuation? Depends on the point you are in your business. and what is the ultimate goal.
So the predictability factor seems like it would be a huge, huge impact.
It is one of the most important ones because of the uncertainty of a new investor. They're coming in with a level of uncertainty. Unless it is a buyout by the management group, there is a level of uncertainty by the new money.
How can our viewers make their businesses more predictable?
Getting contracts. If you're doing ad hoc services, maybe you'll always keep a level of it. There is a value to having flexibility in your schedule. But maybe you're going to also add in some long-term contracts, 1 year, 3 year, 5 year. If you can get those will add extra valuation notches. So especially on your key customer base, you're going to want to have them locked up so that you're not going to be worrying about, or an investor isn't going to worry about it. Either they're going to ding you or you're going to have to stay more involved for more years. In some way or another, they're going to impact you. When you're getting those long-term contracts, you're giving up something, right? You're going to give up your profitability and your margins. You've got to make sure that your profitability and margins are solid, that they're there, and that your sales guys aren't taking advantage. This goes back into having your accounting house in order so that we're there. It's also about the communication between your finance pillar and your sales pillar. If the sales pillar doesn't know where profitability is, then they probably don't know what their margins need to be. So are they giving away the house? Maybe they could be negotiating out a little bit better of a deal for the company. Maybe your compensation metrics need to be different. But having solid margins and having a benchmark is quite important. So when we're looking at that, we're looking at it from a perspective of, are we more profitable or less profitable than our competitors?
Sure. And the way we keep our sales teams accountable is we set parameters from the cost aspect of the job all the way throughout the quoting. So we want to have our salespeople know exactly what it costs, where our targets are as far as profit goes, and have them stay within those parameters.
Right. And so how do we expand our margins? We have obviously there's only two ways to do it. It's either increasing your revenue on a job or it's decreasing your expenses. Ideally, you're going to do both. But if your expenses are going up, AKA maybe you're a restaurant and inflation's happened, eggs this week when I went to the store, almost $9 a dozen. Egg costs are really going up for bakers right now.
Sure.
It's a major problem. Are they increasing the cost of their revenues? If they're not, their margins are getting shrunk. Now we got a problem. How are you going to explain that to an investor that, no, we're actually going to increase the margins? But at the same time, I'm going to go back to my industrial service provider. I just invested in this new equipment, brand new equipment, put $1 million investment in, but that $1 million investment is going to help me shrink my margin or increase my margins by shrinking my cost. Well, I might even be able to offer my services at a lower cost, but because of the equipment that I can invest in, because of the layout or whatever it may be, explaining that, yeah, maybe I didn't do it this way historically because I was good. I was making enough money. I left some meat on the bone for you. We want to make sure we're telling that story going forward, that there is meat on the bone, that, yeah, you can save money here, or you can increase your revenues here and help spread out the profitability.
How does the story play into the investor approach? I hear you talk about stories a lot, and how important is it to have a really good story to tell, and how does that impact evaluation?
At the end of the day, you're trying to sell your company. So we're now operating in your pillar here. We're trying to sell our company. And so as with anything in sales, it's about story. We got a great company. We've done well. We've set it up for fabulous growth coming down the line.
Sure.
If I don't tell it there, then it's not going to be good. If I had Blockbuster in 1990, we still, we're a great growth. We got a great opportunity. Well, maybe we weren't really changing. In 1999, when I had Blockbuster and I'm trying to sell it, it's a very different story. Netflix is coming. What is it that we're seeing here? They didn't see that. They thought everything was going to be kumbaya, and they were relying on the past. Am I investing in Blockbuster in 1999? Am I investing in Blockbuster from 1990 to 99, or am I investing from 2000 to 2010? Blockbuster went bankrupt in that time. So the story is why the past matters to the future, not what I've done in the past.
Mm-hmm.
It's only about how what I did in the past helps me in the future. Maybe I learned important items to help avoid. Maybe we've invested a lot of money into setting up a great process, or we've developed patented processes or products or things like that. What we are doing now or what we've done that helps the future is what this story's about.
Extremely important, telling the story and giving your company the ability to evolve for the future and what's to change and what's to come.
So the last piece is the operating cash flow and burn rate. New investors coming in, how much investment do they need? They got to buy you out, number one. And then number two is they need to be able to fund the operating capital. And number three is if they need to do any major improvements, maybe there's deferred maintenance. Maybe you got to buy a new vessel. Maybe you need a new team, just whatever it is, and understanding what is the cash flow coming back? How fast are they going to make their money back? Private equity group is looking to get out in 5 years.
What's the typical time they want to participate in an investment?
Private equity group is in 5 years. They're going to want to get out. They usually have their private equity funds open for about 10 years maximum. So they want to get in and get out 3 to 5 years. And if they buy your business for $10 million and that business, let's say it's making $2 million a year, so that 5x valuation, how are they going to get that business sold for $20 million in 5 years while also making another $10 to $20 million during those 5 years? That is what they're looking at. They are trying to actively get 20, 30, 40+% annual returns for their investors between cash flow and the capital for the resale of the business. So if we're not factoring that in, then we got a problem. Now, if we stabilize the revenues and we increase our margins, the cash flow should more or less take care of itself.
How does efficiencies play into that aspect? Operational efficiencies.
Those all go back to margins.
Revenue growth generation. Are there other markets we could access? Are there other products we can develop and bolt on and sell?
And a private equity group will likely come in to buy a company either as a add-on to a current investment, or they may be looking for a flagship to put add-ons on there. And identifying those can help identify better ways to get cash flow, other opportunities for growth, ways to increase your revenues, ways to increase your margins by spreading out fixed costs or, taking out some of the competition.
Makes sense.
So as we've said, is the story of the future is important. So we don't want to leave this all about the financials, because quite frankly, we're here to report, we're here to guide, we're here to provide important information. But one of the places that we have to always look at is the sales metrics. When we're looking at the sales metrics, we're looking at the conversion rates. And so, Ross, tell me, how are you tracking conversion rates? Why are they important, and what do they do for you?
Well, the conversion rates are super important to us because it is our KPI as to how fast or what's our time frame to put new customers on, and an indicator as to how fast we're going to grow. The indicator that we need to constantly always be mindful of, because what products and services we're selling.
Right. So how fast we're growing. So if you're a company, how fast you're growing or how fast you're closing your sale, how many leads do you need? All that goes in that conversion rate. Are you generating enough leads, or do you have some additional growth capacity, assuming operations capacity either has the capacity or is able to obtain it to be able to fulfill it? Again, story to the future.
Yeah. We want to keep our conversion rate always in front of us, because we want to compete with ourselves and the rest of our team on making that conversion rate better. The faster we make it better while maintaining our customer message and our integrity is going to help indicate the direction of the ship and our growth trajectory.
Yeah. So if you're thinking about this from a roofing company, post a hurricane, their conversion rates are through the roof, pun intended. But as we get further and further away from a hurricane, those roofs are not going to be there. you have all the damage, and then the conversion rates are going to come down. Having that consistency, or how are we going to account for that conversion rates? Don't want to own the roofing company before the hurricane or after the hurricane.
I think that is a great example because it's an emergency response type of situation. How attractive for an investor is that roofing company versus a company in the industrial space with predictable contracts?
I'll challenge you something different. Which is more attractive? The roofing company that made $2 million right after Hurricane Ida a year, and then went back down to $200,000 the next year. It was making $200,000 a year before, or the roofing company that made $600,000 the year before, only $1 million Hurricane Ida, and made $650,000 the year after. Which one's more valuable?
I'm going for the latter every time.
But they made less money over those 3 years.
Doesn't matter. They have a platform that is more consistent.
Right. So I might make more money because I have this, but because I have the consistency, we're there. My guess is my conversion rate is better with the company that is making more money. It's a higher conversion rate on a more consistent level than the other company. Customer acquisition costs. Ross, how are you tracking these?
Through our CRM system. Everything that we put into the system is going to allow us to see the analytics as to the time, the costs, everything that we're investing in that customer acquisition.
So how important is this in terms of your metrics when you're communicating or managing your sales team?
Extremely important, because it's going to also not only how it affects the acquisition time, but also how it affects our profitability. Just like with conversion rates, we constantly want to improve that time frame with the customer acquisition. We also want to have this metric available to us leaders and the team so that we could constantly improve it. Salespeople are generally competitive people. We also want to compete against ourselves and improve these numbers. If we improve in these numbers for ourselves, we're improving the profitability for the company.
So I'm going to turn this a little bit. I'm going to bring this back to profitability and margins that we were talked about earlier in the financial metrics. If our conversion rate is 5%, and let's say benchmark average in our industry is 3%, but cost of acquisition of a customer is high, then we need to figure out where that balance is, correct? Maybe we shouldn't be converting quite so high. Maybe our conversion rate is too high because our cost of acquisition's not there. Maybe we don't have enough margins, and that's why we're winning all these jobs. But at the end of the day, is it better to make $1 million off of 10 customers or off of 100 customers? The answer depends.
I would much rather make it off of 1 million customers because that may lend
For the same amount of income?
It may lend to diversification.
Sure. But again, if I'm making $1 million, I'm going to want to make as much money off of individual customers without necessarily having to do as much work.
Yeah, so the balance is paramount.
So there is a balance there. We always are trying to figure that out. But tracking the customer acquisition costs is vitally important. You always heard it on Shark Tank. What's your customer acquisition cost? Do you know? That number should come down over time. The more the marketing, the more the advertising sets in, that cheaper it is. The better you are at completing your sales process, that should help bring down the acquisition cost.
It's also going to tell us exactly how heavyweight our sales team is or underweight. A lot of times we invest in sales teams and we don't know exactly how many people we really need for a specific region. So by finding that balance and making it a priority to find that is very important.
Right. Then the last piece, I think, on the sales side is the churn rate. How many customers are you keeping every year and how many are you getting new? From an investor perspective on this, the lower my churn rate on new customers, the longer that they've been customers of mine, the more likely they are to stay with me. It's not 100%. It's not always true, but generally speaking, it's more likely they're going to stay with me. If they've been a customer of mine for 10 years, do you really think they're going to leave now if everything else stays the same?
They shouldn't.
They shouldn't. There may be reasons. Maybe they're retiring. Maybe you mess up. But generally speaking, that shows the consistency of the operations and the consistency of the customer service. And when we're talking about the future, we want to know predictability. Are we going to be more likely to say, you've had a customer for 10 years, that customer is going to stay over your last 10 years, you've lost 5% of your customers, which is that pretty attractive? Maybe you weren't quite as profitable as you could have been, but you've maintained that. Or, hey, you've lost 30% of your customers. You're immensely profitable on a margin basis, but at what point are you running through all your customers?
At what point are you going to run out?
Right.
Is there a such thing as a bad customer?
Always.
How do we handle bad customers?
Well, there's a lot of different ways to handle those. That's probably a topic on its own. But of course, you can have a bad customer. Are you losing money on the customer? Are they taking too much time?
Do they value your service?
Do they value you? Do they value your service? Do they value your employees? Are they advocates for you? Would I rather a customer that sends me 5 clients, 5 referrals, but maybe I don't charge them as much as I should, or I spend a lot more time with them? Or would I rather a customer that's going to pay me a top dollar, but will never refer me out, will never show appreciation, and is still going to take just as much time? I think the answer is maybe both. I like them both, but you've got to certainly evaluate it. And if it's just a qualitative valuation or just a quantitative valuation, you're missing it. There is a value to the quality and a value to the quantity or the calculative nature of it. And so we always try to tell that story. That qualitative portion of our story is the story that we get to tell. It's the story we really get to maneuver. We can maneuver the quantitatives too, but it usually follows the qualitative aspect.
Well said.
So getting a little bit more in the nitty gritty on specific things that you're going to need to do. Like I said, oftentimes investors are going to look at 3 to 5 years into the past. And what are they looking for? They're looking for your trends. Are you trending up in the revenue? Are you trending down? Is your profitability going up or down? Is it consistent? Are we failing to be cash flow positive? Are we missing payments? Things like that. If we show, you're going to have blips. It's not going to all be just nice and rosy or all the way there. Business doesn't work that way. There's going to be the ups and the downs, and we're going to appreciate the ride. But we want to make sure we're showing it up, and we want to make sure we learn from the downs. If we're going down, why did we go down? How do you tell that story on, well, the market went through COVID. Restaurant lost a lot of money that year, Ross. It kind of makes sense, right? An investor is going to understand that, and they need to educate themselves. We're going to educate them on why our business experienced the stumbles that we experienced, what we learned from it, how we're going to avoid having those experiences going forward.
How versatile your company is to pivot. Is it nimble? Can it afford to? Does it have the operations capability to do so also?
And so from those 3 to 5 years, along with those qualitative aspects, we're going to create a 5-year projection. Usually the first 12 months is going to be a monthly projection or quarterly, and then annually after that. What's the value of that projection? That is always the question I have. To me, it's whatever piece of paper you print it on, because who really knows? Contracts you have, more stability in revenue, the more valuable those projections are. But that's certainly relying on certain pieces to it. The less you have, you're making up the story and you're trying to sell it. And now the investor is going to make up their own story, and they're going to try to ding you. And it's just part of the game.
Also, how identifiable are all of your systems? Your finance system, your sales system, your operations system, and your products and services systems. How easy are they to identify, and are those processes tangible? Are they written down? Are they easy to access and to look at?
And then what they're doing from the projections is they're looking at, where's our break even? Again, if we're trying to get out of this investment in 3 to 5 years, we better know how many years before we can get our money back, because we need that money back to go and put it into another investment or to return capital, whatever it may be. So having a clear story to getting that money back, working from the projections, working from the sales flow, the funnels, all of that brings us back. Lastly, how are we selling our business? That's oftentimes, it depends on how big of a business you are. Depends on what's your goals. Are you looking to stay in the business? You're looking to exit the business? What we're doing there. A lot of times you might use an investment banker. You could use business brokers. You may try to talk to certain people. Management's always a good option. It really depends on what is the goal. Is the goal maximizing your exit? Is the goal making sure that you have a smooth transition for your employees? And usually it's some sort of combination. So there's many different ways to talk about sales and tactics and strategies there. And we're definitely going to dive into that in another podcast. We'll get an investment banker on here to really dive into those on there. But making sure we have the proper story is important in any situation. If we don't have proper story, we don't make sure we get ourselves ready, then the valuation is just not going to be what it could be. And then the other thing is when you're exiting, how much cash you want up front, how much stock you're holding back, different things like that. And, what are the terms? Everything comes back down to the terms. So just to recap everything, we talked about the financial metrics today, talking about profitability, talking about revenue, stability, and cash flow, the sales metrics, churn rate and all conversion rate. And all of this is all about building the story to an investor that is looking to put their money into your business, whether to buy you out or to invest in your business. And we're here to help.
We are excited for you to be part of this journey with us. And as always, we strive to provide valuable insights, strategy, guidance, and stories that help you improve. Whether you're an entrepreneur, a student, or someone looking to make a positive change in your business, this podcast will offer your company tools, knowledge, and strategies to help you excel. Thank you for tuning into this episode of Pop for Success podcast. Subscribe and stay tuned for more insights, strategies, and success stories in our upcoming episodes. Until next time, keep optimizing, keep growing, and keep succeeding.